Welcome back to the channel. My name is Derek Coffey, and I'm the founder of FWP. And sporadically, I'll come across a news article that I feel the urge to share with you. This article specifically is from 24/7 Wall Street, and what they're saying is that you can take three exchange-traded funds and replace your retirement portfolio. Now, in retirement, we typically err on the side of caution and go with a 60-40 portfolio, where 60% of your money is in stocks and 40% is in bonds. But with these three funds specifically, you can create the same level of diversification, you can create the same levels of growth, but do it all with zero bond exposure. In this video, I'm going to get into those three ETFs, and we're going to cover what they are, how they operate, as well as how they performed against the 60-40 portfolio over the last decade. Stay tuned. Normally, when I come across an article like this, I just pass it off as clickbait. I don't bother clicking on it at all. But for this instance, I did. And the more that I read about it, the more that I got to thinking that, hey, this could actually work. Now, the reason that we normally go with something like a 60-40 portfolio is because we're looking for assets that are uncorrelated. What we mean by that is that when one position goes up, the other one goes down, and vice versa. This is just the basics of diversification. But the 60-40 portfolio over time has begun losing that uncorrelated relationship. With bonds, the value of those bonds operate the same. They always have and they always will. If interest rates go up, the value of bonds go down. If interest rates go down, the value of bonds go up. Stocks, on the other hand, haven't for a long period of time until recently. The major indexes are heavily weighted towards technology, and the interest rates affect the value of technology stocks the same way that they do bonds. Because of this, you have years like 2022, where interest rates were on the rise, tech positions were going down, and bonds were going down as well. That sensitivity to interest rates has correlated stocks and bonds. With the three ETF portfolio that we're going to go over, our goal is to get away from some of that correlation. Now, what you see on your screen is a layout of what each of these portfolios look like. And the first one that we're going to cover is the 60-40. With the 60-40 portfolio, 60% of your money is in stocks, 40% is in bonds. And if we use VOO, or the Vanguard S&P 500 ETF, and BND, the Vanguard Total Bond Market ETF, we can see that over 33% of your money, at least in the stock positions, is in technology. That's in addition to the other 40% of your portfolio that's exposed to bonds. Now, if I do some simple math, that puts approximately 60% of your overall portfolio that's exposed to interest rate sensitivity. If those interest rates continue to go up, then the value of the technology and the bond positions are going to go down. Now, the reverse side of that coin is also true. If interest rates begin coming down, then that 60% is going to go up. But the goal of building a portfolio is to avoid that direct correlation, and that's where the alternative comes in. With the alternative portfolio, we're going to use those three funds that were mentioned in the article. Now, the first one is VOO. That's our S&P 500 exposure. That's the growth exposure that we want in our portfolio. The second position is VPU, or the Vanguard Utilities ETF. Now, VPU I actually used when I managed clients' money, and the reason this is because it's a great hedge when the markets perform poorly. Utilities are highly regulated, and they typically pay pretty good dividends, so when the markets tend to go south, utilities help even things out, similar to bonds. With utilities specifically, I want you to think of electricity. And the reason this is because as tech companies continue chasing the capabilities of AI, they're going to need more energy, or electricity. So holding utilities in your portfolio is going to give you a roundabout exposure to technology companies, because as the demand for electricity increases, the value of utilities are going to increase as well. The final piece, or that third fund that was mentioned in the article, is SCHD, or the Schwab US Dividend ETF. Now, the reason the 60-40 portfolio worked for so long, and it still does work, is because of that bond component and the income that those bonds create. So to help replace that without having the bond exposure, we're going to use a dividend ETF. With SCHD, it holds just over 100 positions in the highest quality dividend paying companies that are on the market. So if we were to take an investment portfolio and put 34% of the money into the S&P, 33% into utilities, and then 33% into the dividend fund, your portfolio is going to look vastly different than being in a 60/40 portfolio. In a 60/40 portfolio, with that stock component, 33% of that money is going to be in technology. With the alternative, 33% of your money ends up in utilities. Now, normally, that heavy of a weighting towards any sector gives you reason to stress a little, but utilities, unlike technology, is a little bit more stable because of that income component and because of the regulations. Now, you don't lose your technology exposure completely. You still have 15%, and that's still going to create a decent amount of growth within this portfolio, and we're going to see that here in a second. But with the alternative, the goal is to smooth out the process and get those positions as uncorrelated as possible. So we've gone over the traditional 60/40, we've gone over the 60/40 alternative, and we've talked about everything that's going on behind the scenes. But the information that you actually care about is how these portfolios have performed over time. Since January of 2012, the 60/40 alternative has returned on average 13.1% per year. If we compare that to the traditional 60/40, it has returned almost 10% on average per year. Now, if we lay this out over this course of time, we can see just how volatile each of these portfolios are. As we would expect, the 60/40 portfolio is the kind of steady eddy of the two. It's very steady. There's not a lot of ups and downs or very sharp movements, at least when you compare it to the 60/40 alternative. Especially after the pandemic, the 60/40 alternative did get a little choppy from late 2021 and even through today. So if you're looking for the most steady, then the 60/40 is probably right for you. But again, if you can stand that little bit of extra volatility, the 60/40 alternative is going to return you an additional 3%, which I think is a fairly decent compensation for that additional stress. Now, if we look at it per year, there are a couple of years where the alternative didn't perform that well. In 2012, it was down by 1.5% compared to the traditional 60/40. In 2015, it actually lost money when the 60/40 was up 1%. In 2020, when the pandemic happened and interest rates crashed to zero, the 60/40 portfolio performed very well compared to the alternative. And then in 2021, coming out of the pandemic, the 60/40 alternative smoked the traditional 60/40. Now we get to 2022 when the whole world fell apart, and this is where the three funds really were worth their salt. Having those three funds limited losses to just under 7% compared to just over 16% for the traditional 60/40 portfolio. Now, coming out of 22, the traditional 60/40 performed very well. It beat the alternative by almost 10%. But then when we get into 2024, the alternative really begins to separate itself. Now, if we want to look at this side by side, I laid it out in an Excel sheet. And the reason that I did this is because I want to show you why the correlation matters so much. In the early 2010s, stocks and bonds were relatively uncorrelated. In 2012, bonds were up 4%, stocks were up 16%. But then in 2013, when bonds were down just over 2%, stocks were up just over 32%. And that's the uncorrelated positions that we're looking for. Now, from 2014 to 2017, none of that mattered. Everything was making money, everything was great. But then we get to 2018. In 2018, bonds lost money. Yes, it was 11 basis points, but it was still a loss for the year. And then stocks lost right at 4.5%. The reason that we want the uncorrelated assets is because when you rebalance your portfolio to create the income that you need for the next year, you're going to have to sell something at a loss. Because you only have the two positions, which you can build a 60/40 however you wish, but we're just using these two for simplicity. But if you were to only use two funds, you would have had to have sold one of them at a loss to create the income that you need. Now, in 2022, it was a rinse and repeat of 2018. The only difference is both positions were down heavily, and this is the correlation that we want to avoid. So not only are you going to be selling at a loss, but you're going to be selling at a loss of 13% because we're going to pick the one that hasn't lost as much. So when it comes to building your retirement portfolio, you want it to be as uncorrelated as possible. All right, I'm done beating that horse. I'm not bashing the 60/40 portfolio. It does work, just depends on your situation. To show you that it works, if we take the annual returns that we received from the 60/40 portfolio and coupled that with a 4% withdrawal rate, we can see that a $500,000 portfolio in 2012 with those 4% withdrawals would turn into just over $1 million at the end of 12 years. So the 60/40 does work. It's just there may be a way to make it a little bit better. Now, if we look at the same asset layout with the 60/40 alternative, we're going to see some of the same scenarios. In 2012, everything was up. In 2013, everything was up, but that's just because we didn't have the bond position like the 60/40 portfolio. When we get to 2015, stocks were actually up. So despite the fact that the other two positions were down, we still had a positive position to pull income from. And when we get to 2018 and then again in 2020, utilities saved the day. When the dividend payers were down and the S&P was down, utilities were there to give you that positive position to pull your income from. Now, if we compare those annual returns over those 12 years, starting with the same $500,000 and the 4% withdrawal rate, things look vastly different. And this is because you don't have that bond exposure. Once we get to the end of those 12 years, you're going to have just shy of $1.6 million in your account. And this is a product of that additional 3% of return that you're going to get for the increased volatility. Now, it's not as volatile as being 100% in stocks, but it is a little bit more volatile than that traditional 60/40. But those little ups and downs are definitely worth an additional $550,000 in your account. Now, I don't want you to go and give up on a 60/40 portfolio just because there might be a little bit better alternative. For most people, a 60/40 or a 50/50 portfolio is going to be just fine, and it's probably going to fit their situation better than the 60/40 alternative. And the reason this is because the volatility and the stress that's associated with that additional volatility just isn't worth the 3% of additional returns. Like we said, the 60/40 works just fine. But if you're in a position that you can take on a little bit of additional risk with your investments, then the 60/40 alternative is something that maybe you should consider. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that's fine with the 60/40 portfolio, but maybe wants to add a little bit more growth potential to that portfolio, then send this video to them for something to consider. But I thank you so much for tuning in. I'll talk to you soon.